Hi, this is Kelly Wright at the Money Show in San Francisco. Joining me right now is Mr. Thomas Grimes of Reeves Asset Management. They've forgotten more about utilities than you and I collectively have ever known. So, all the rage in parts of our industry, when you talk about asset allocation, is passive versus active. Okay. And according to some, you can't beat them, so you just own everything. All right. Now, I personally think that's shibboleth, but that's me. Okay, so you guys don't use passive investing in your ETF, do you?
No, we don't. Kelly, we clearly subscribe to the philosophy of active management. We think it's very important with your hard-earned money and savings to invest in things where someone has actually done the work and understand what they're putting in their portfolio.
Shocking idea.
Right. So, so when we decided to launch our ETF, ticker symbol UTES, Reeves Utilities ETF, 3 years ago, we had an idea based on our past performance, because we've been investing in utilities for over 40 years, that we could beat the passive S&P 500 Utilities Index through good, solid, fundamental research and active stock picking.
Okay.
So we've created a portfolio that's varied over the last 3 years from about 20 to 25 stocks. It's our best ideas in the utilities sector.
Okay.
And we're really focused on utilities that can grow their earnings, that can grow their dividends, and can generate a good solid total return, which is a combination of the income from the dividend and the capital appreciation.
See now, when most people think about utilities, that word growth never enters the conversation. It's always about yield.
Yes.
Okay, and then the second part of the conversation is what's going to happen to my yield, when interest rates go up. But that's another discussion for another time. I want to focus on the growth part because I don't think enough people pay attention to that. I mean, a utility is an operating company. It may be a utility, but it's still an operating company, and so help us out with that.
Well, the first thing we always remind our clients and prospective clients is that the utilities we invest in, we're investing in the common stocks.
Right.
We are not investing in bonds. When you invest in a bond, there's a fixed coupon.
Indeed.
And so if interest rates go up, your coupon is not increasing, and therefore the value of the bond will decline. It's
rough.
It's just one of the laws of nature.
Yeah.
If you own a common stock of an operating company, as you said, that is running its business well and is growing,
right,
you can overcome those interest rate increases through dividend increases. I'll give you a couple examples just since you brought up the interest rate topic. From June 2003 to June 2006, the Fed raised interest rates 17 times, from 1% to 5.25%.
How did they have time for anything else?
Well, utility stocks went up 63% in that 3-year period.
See, that's counterintuitive.
Exactly.
Yeah.
And more recently, right after we launched our ETF in September of 2015, in December, the Fed began another period of tightening, and we've gone from 1% to 5.25%, 7 increases, and utility stocks are up 36% during that period. And it's because the fundamentals of the companies right now are actually very, very good. They're growing their earnings. There's been a few areas of trouble. A few of the companies in California have been caught up in the wildfire mess where they're being held responsible for causing the wildfires. That's going to be litigated, and the legislature is very much involved. But Pacific Gas and Electric, a major utility in the passive index, has had to eliminate its dividend during that period. Our ETF does not own that stock, and that's the beauty of active management. You can avoid these risky situations and focus on the companies with a much better environment.
This whole active versus passive thing, it's a cyclical argument. I think the passive guys, their day is coming, and people are going to wish they had a good active manager.
A more volatile market usually creates more opportunities for active managers.
And then as Brother Buffett says, when the tide goes out, we get to find out who's been swimming naked.
Yeah, no, that's absolutely
there
true.
You go.
That's absolutely true.
Hey, this is my friend Tom Grimes of Reeves Asset Management. I'm Kelly Wright. Thank you for joining us at the Money Show in San Francisco.
Thank you, Kelly.